U.S. Federal Reserve has raised its key interest rate. America's central bank projects 3 more increases in 2017. It's a sign that one of the world's largest economies is returning to normal. But what does that mean for this country? Will the Bank of Canada follow suit? We begin our coverage with Eric Sorensen.
It's the surest sign the U.S. economy is on solid footing. Not just that the Fed rate rose for the first time in a year and the second time in a decade, but that it surprised no one.
A quarter-point hike, the Federal Reserve in a unanimous decision. It's what everybody expected.
The rate hike is a vote of confidence in an economy that created more than 2 million jobs in the last year.
Unemployment has fallen further, and inflation has moved closer to our longer-run goal of 2%. We expect the economy will continue to perform well.
What then does this mean for the Canadian economy? A U.S. rate hike, while Canadian rates stand pat, drives home the fact that the U.S. economy is stronger and will put downward pressure on the Canadian dollar, though that's not necessarily a bad thing. When the U.S. gets humming, the Canadian economy picks up steam too.
The United States is the destination for more than 70% of all Canadian exports. And as a consequence, if the U.S. economy is improving and warrants higher interest rates and can support higher interest rates, that's actually a positive outlook for Canadian trade.
The U.S. Fed rate is now a quarter point higher than Canada's 0.5% bank rate, the first time the key U.S. rate has been higher than the Canadian rate since 2007. And the Federal Reserve is forecasting U.S. rates will rise 3 more times next year. The knock-on effect could push some Canadian rates higher down the road.
Well, I just want to thank everybody.
Then there is the Trump effect. The president-elect met today with tech industry CEOs, creating anticipation for an even hotter economy when he takes office.
I'm here to help you folks do well.
The stock markets have been rising since Trump's election as he promises tax cuts and infrastructure spending, all of which could introduce a new risk to the economy, inflation, something the U.S. Fed has not worried about in years.
For the past 8 years or so, they've been really focused on unemployment, but what we may be seeing now is a tick over to their other mandate where they start to look at the danger of inflation.
So it may be 3 U.S. interest rate hikes next year at a minimum to keep the U.S. economy from overheating. Eric Sorensen, Global News, Washington.